Revision 13 is all about risk. This looks at the balance sheet and is question 3 of the interpret paper. The first part of risk is liquid ratio. It asks the question, can the business pay their debts in the 0 to 3 months or immediate term? We want that to be over 1 to 1. The current ratio is, can the business pay their debts in the short term, 0 months through to 1 year, and we want that to really be over 1.5 to 1. And the equity ratio is, how's the business financed? What proportion by the owner and what proportion by liabilities? We want the owner to fund more than 60% of that. Normally in this question, you'll get a balance sheet looking like this. So in the balance sheet, you won't get everything, so they may not give you the capital. You may have to work that out. But you can see we've got liquid assets and liabilities. So we'll just pause here. And I've put this in a spreadsheet. What you're expected to do is go and code them on the side first. So for bank, we're going to write LA for liquid asset and CA for current asset. Same with the next one. For accounts receivable, it's a liquid asset and it's a current asset. Inventory is only a current asset, but not a liquid one. Prepayment's a current asset. Those ones, we may not get our money back from them quickly. Term deposit is a non-current asset. And we've got these ones are both liquid liabilities and current liabilities. The only one that's not is bank overdraft if it's secured. The loan is a non-current liability. And owner's equity is one you're going to have to calculate. So to calculate owner's equity, it's going to be equal to your total assets minus total liabilities. Great. So first thing to do is calculate your liquid ratio. So liquid assets, that's these two, 10,000, divided by your liquid liabilities, that's these two, 12,000. And you can see the formula is 0.83 to 1. That means in 2022, for every dollar of the bottom line of the equation, liquid liabilities, Lucky Luke's has 83 cents of liquid assets to cover it, which means they may have difficulty paying their immediate debts. Some key terms here. Current ratio, we've got 35,000, so all those current assets added together, divided by current liabilities, 12,000, so is 2.92 to 1. That means in 2022, say it with me, for every dollar of current liabilities, Lucky Luke's has $2.92 of current assets to cover it, which means they should be able to cover their short-term debts, immediate debts, short-term debts. And we'll just get that calculation right. For equity ratio, we've got the owner's equity, 61,000, which we calculated, divided by the total assets, 107,000. So that gives us 0.57. So that means for every dollar of, in 2022, for every dollar of, bottom line, total assets, the owner, or Luke, has financed 57 cents. This means that Luke has financed more than half. We've said here that it should be greater than 0.6, so he may have difficulty getting new loans. All the best with the Kahoot. See you in revision 14.